It is 11:17 in the morning. The trader loses 18,000 rupees. In 6 minutes, he moves closer to the screen and doubles his position. Across the city, another trader cancels lunch. One red candle has ruined her mood. Somewhere else, a man who promised to stop trading for the day opens the app again. While standing in a lift, they think they are trying to recover money. But money is only the scoreboard. They are playing a hidden game, and the game is playing them back. The first loss does not feel dangerous. Feels irritating. You entered a trade with a clean setup. You had a reason. Maybe the market moved suddenly. Maybe your stop loss was hit by a wick before the price reversed. Maybe you ignored your own plan for 5 seconds and watched the trade collapse. Now there is a number glowing on the screen. Minus 18,000 rupees. The number is small enough to recover. That is what makes the next decision feel reasonable. You scan the chart again. Your shoulders tighten. Your eyes move faster. You find another entry. It is not as clean as the first one, but it could work. If it works, the day returns to normal. If it works, you can close the laptop without carrying that number into the evening. So you increase the position. The second loss arrives faster. Now the screen says minus 41,000 rupees. Something changes. You are no longer asking, is this a good trade? You are asking, how quickly can I erase this feeling? That question is the entrance to the game. A trader I know once lost 12,000 rupees before breakfast. It was annoying but manageable. By noon, he had turned that loss into 86,000 rupees. He did not take one reckless bet. That would have been easy to notice. He took 7 increasingly desperate trades. Each one was slightly larger than the last. Every trade felt like the last trade. Every entry came with the same promise. Recover the loss, then stop. At 3:20 he closed the app. He sat quietly in his parked car for almost an hour. The strange part was not the money. He said the first loss felt worse than the final loss. The first loss offended him. The final loss exhausted him. You are probably thinking you would notice the moment it became irrational. You would take the hit. You would walk away. But revenge trading rarely announces itself as revenge. It often arrives disguised as discipline. You tell yourself you are staying focused. You tell yourself the opportunity is still there. You tell yourself the next position is part of the plan. Even though the plan did not include your heart beating this fast. This is what makes it a game. A game has players. It has rules. It has a scoreboard. It changes your behavior by making certain moves feel urgent. In revenge trading, the market is not the only player. There is the version of you who entered the first trade. There is the version of you who now wants to prove that the first version was right. There is the screen, updating every second. There is the memory of the money you had 30 minutes ago. And there is the imagined future where one perfect trade repairs the entire day. The market does not need to defeat you. It only needs to keep the scoreboard visible. Visible long enough for you to begin competing against your own previous balance. That is where the hidden rules start to appear. The invisible game of revenge trading begins when a financial loss becomes a psychological debt. That distinction matters. A financial loss is a number, can be measured, can be accepted. It can be placed inside a larger system. A psychological debt feels personal. It says something has been taken from you, and you must get it back before you are allowed to relax. The game has 3 rules. The first rule is simple. The scoreboard resets at your highest recent balance. Imagine you start the morning with 2 lakh rupees in your trading account. Your first trade makes 24,000 rupees. For a few minutes, your balance is 2.24 lakh rupees. Then your next trade loses 18,000 rupees. You are still up 6,000 rupees for the day. But that is not how it feels. Your brain quietly updates the reference point. It begins treating 2.24 lakh rupees as the money that belongs to you. Now 2.06 lakh rupees feels like a loss, even though you started the morning with less. Psychologists call this reference dependence. You do not experience money as an absolute number. You experience it relative to a mental anchor. The anchor moves quickly when the number rises. It moves slowly when the number falls. That is why giving back a profit can hurt more than missing the profit entirely. 5 minutes ago, the higher balance was only a temporary number on a screen. But once you saw it, your mind began defending it like property. The second rule is more subtle. A loss creates an unfinished story. The brain dislikes unfinished stories. A song that stops before the final note stays in your head. A message left unseen keeps pulling your attention back. A trade closed at a loss does something similar. Creates a loop. Your mind keeps replaying the entry. You imagine the version where you waited longer. You picture the candle reversing just after your exit. You open the chart again, not because the chart has changed, but because the story feels incomplete. This is related to what psychologists call the Zeigarnik effect. Incomplete tasks often remain more mentally active than completed ones. A losing trade can feel unfinished even after it has been closed. So the next trade receives a hidden assignment. It is no longer just a new trade. It must finish the emotional work of the previous one. That is an impossible job. A clean trade can be evaluated on its own terms. A revenge trade must carry your frustration, your embarrassment, your urgency, and your hope of relief. The chart becomes a courtroom. You are not looking for opportunity. You are looking for a verdict. The third rule is the most dangerous. The game rewards speed. After a loss, waiting feels like weakness. Doing nothing feels like accepting defeat. The next candle looks unusually important. It appears to offer a quick exit from discomfort. You begin to prefer immediate recovery over good decision-making. This is where the amygdala matters. The amygdala helps detect threats and emotional significance. A red number on a screen is not a physical threat, but the body can still respond as if something urgent has happened. Your breathing changes. Your attention narrows. Your time horizon collapses. A decision that would look absurd tomorrow can feel necessary. In the next 30 seconds, the game does not need you to become foolish. It only needs you to become impatient. Once impatience takes over, position size begins to creep upward. If the first trade lost 5,000 rupees, the next one should make 5,000 rupees. If the second trade loses 2, the third one must recover 12,000 rupees. The target expands. The time available shrinks. Soon, you are asking a single trade to repair an entire sequence of decisions. This is why revenge trading resembles chasing losses in gambling. Not because trading and gambling are identical. They are not. A trader may have a real strategy, risk rules, and an edge over many trades. But the moment a new position is opened mainly to remove the pain of the previous one, the decision has entered the same psychological territory. The scoreboard becomes emotional. The next move becomes compulsory. And the player begins chasing relief instead of returns. You can see this pattern outside markets. Someone receives a harsh comment in a meeting. They spend the afternoon trying to prove their value through unnecessary work. Someone loses an argument. They keep sending messages long after the relationship has stopped benefiting from the conversation. Someone breaks a diet at lunch. They decide the entire day is already ruined. The surface behavior changes. The hidden logic stays the same. A small loss creates psychological debt. The mind demands immediate repayment. Then the repayment attempt creates a larger loss. The player is no longer solving the original problem. The player is serving the game. The scoreboard in revenge trading is not your account balance. It is the distance between how you feel and how you felt before the loss. That is why recovering the exact amount can feel so satisfying for a few minutes. The money closes the emotional loop, but it teaches the wrong lesson. It teaches your brain that discomfort should be treated with another trade. The next time you lose, the urge returns faster, and the entry fee becomes larger. Once you see the game, the most useful question changes. The question is no longer, can I recover this loss? You probably can. Given enough risk, almost any small loss can be recovered in the short term. The better question is, what kind of behavior am I training right now? That question sounds less dramatic. It is also harder to escape. If a loss makes you increase position size, you are training escalation. If a red number makes you abandon your time horizon, you are training urgency. If one impulsive trade occasionally saves the day, you are training your brain to trust impulses. Precisely when your judgment is most distorted. A profitable revenge trade is not always a victory. Sometimes it is the most expensive possible outcome, because it teaches the game how to keep you playing. A trader I know had a rule that sounded almost childish. After any trade that made him feel angry, he had to stand up. Then he had to place a glass of water on the other side of the room. The point was not hydration. The point was to break the illusion that the next move had to happen inside the next 10 seconds. His rule created physical distance from the scoreboard. He could still return to the desk. He could still take another position. But the next trade had to survive a few quiet minutes. A few quiet minutes outside the emotional weather of the first one. That small interruption changed the game. Because revenge trading depends on a compressed timeline. It needs the previous loss to remain vivid. It needs your body to stay activated. It needs the next candle to feel like the final train leaving the station. Time is not a delay in this game. Time is a change of rules. There is another move that matters even more. Before the trading day begins, decide what happens after a loss. Not how much money you hope to make. Not what you will buy when the month goes well. Decide what a loss is allowed to change. For example, after 2 consecutive losses, position size cannot increase for the rest of the session. Or, after 1 trade taken outside the written setup, trading ends for the day. Or, after the daily loss limit is reached, the app is logged out on the phone and the laptop. The exact rule depends on the person. The principle does not. A decision made before the emotional debt appears has more authority. More authority than a decision made while you are trying to repay it. You are not proving that you are stronger than your emotions. You are accepting that the version of you who is calm should set boundaries. Boundaries for the version of you who is not. That is not a trading trick. It is a design choice. The same idea appears in casinos. The casino does not need to predict which hand you will play badly. It designs the room so that time becomes difficult to feel. There are few reminders to stop. The next move is always available. The distance between discomfort and action is tiny. A trading app can create a similar environment without intending to. The market is always moving. The button is always there. Your profit and loss updates instantly. You can convert an emotion into a position before the emotion has even formed a complete sentence. So the useful move is not heroic self-control. It is friction. Friction is the small gap between feeling and action. It can be a 5-minute timer. It can be a written note beside the screen. Would I take this trade if the previous trade had made money? That single question exposes many revenge trades. If the answer is no, the setup is not the reason for the entry. The emotional debt is. Friction can also be a fixed position size that cannot be changed during the session. Or a separate trading account with a limited balance. Or a rule that every new entry after a loss must be written down before it is placed. These moves may feel boring. That is their purpose. The game feeds on urgency. Boredom starves it. There are 2 ways to respond once you recognize the invisible game. The first is to keep playing but with awareness. You accept that losses are part of the environment. You treat them as the cost of gathering information across many trades. You build rules that assume your perception will become less reliable after a painful outcome. You stop demanding that the next trade make the previous trade meaningful. Each trade stands alone. The second path is to refuse the game for a while. This does not mean quitting markets forever. It means leaving the scoreboard when the scoreboard becomes emotional. You close the app. You let the loss remain unresolved. You carry the slight discomfort into the afternoon, without asking the market to remove it. This can feel surprisingly difficult, because leaving a loss alone means accepting a story without a satisfying ending. But that is the deeper skill. Not predicting every move. Not winning back every rupee. The skill is allowing a bad trade to stay small. This matters far beyond markets. Many expensive decisions begin with a small emotional debt. You buy something unnecessary because you had a miserable week and feel owed a reward. You stay in a failing project because walking away would make the previous effort feel wasted. You take a larger risk because the smaller risk embarrassed you. You do not need to become emotionless. That would be another fantasy. You need to notice when a decision has been quietly assigned a second job. A purchase should not repair your self-worth. A new investment should not rescue an old investment. A trade should not restore your dignity. When money is asked to settle an emotional score, the scoreboard stops telling you what you think it is telling you. The number may still be accurate, but the game has changed. Revenge trading looks like a market problem because the evidence appears on a chart. But the chart is only where the pattern becomes visible. The deeper game is the need to erase discomfort immediately. Once you notice it, you begin seeing it everywhere. In spending, in investing, in careers, in relationships with status, risk, and regret. Money is unusual because it gives these invisible games a scoreboard. A number changes and your behavior changes with it. You start making moves without realizing the rules have shifted. That is what this channel maps. Not just how people earn money or lose it. How money quietly changes the games people think they are playing. The next game is even harder to notice, because it often looks responsible from the outside. It begins when one bad decision has already cost you money, and your mind starts defending the cost, instead of defending your future. Until then, remember this. A loss does not become dangerous when the number turns red. It becomes dangerous when the next decision is asked to make the red number disappear.